What is wrong with the crude oil market? Has it completely lost all sense of anything that's going on? If you believe the headlines hitting the tape, we should be looking at chaos. And we are very much not. What's happening? Welcome to Macro Money. This is Ilya Spivak, head of tastylive. And in the absence of big splash economic data, we are going to focus on what in the world has been happening in crude oil, not only recently, though of course that, but also just over the course of this year, and try to make sense of what in the world is going on, because if the conventional wisdom were to prevail, and if one were to take the current headlines at face value, one would think that crude oil should be screaming higher. And it's doing anything but. So let's unpack this here and see not only what this means for crude oil, but what this means for the global economy writ large. Because the message in the way that this very liquid, very closely monitored market is going to be telegraphed into other assets, into the economic outlook, into whatever else is going on. That message might be very insightful indeed. So let's begin here, first and foremost, with where it is that crude actually is and why it is so strange that this is where we find ourselves. So consider here first that what we're looking at, and this is a monthly chart over 10 years. So we're definitely going for the big picture perspective. What we have is something of a strange set of circumstances. So needless to say, here's COVID, right? This is the beginning of 2020. Demand for crude collapses because, of course, the global economy is locked down almost in its entirety. And so what you end up with is, of course, a large sell-off. Like everything else in the early part of the year, there is a forceful exhaustion spike, then bounce, because the Fed comes out and says, everybody relax. We're going to do open-ended QE. There's going to be all the money anybody can get their hands on available. And so whatever terrible economic outcomes await, you can paper over them with essentially costless credit. In other words, if you lose money, you can borrow more for nothing. And so everything starts to rebuild. Needless to say, that is a process that gets more and more support as you move into 2021, because what you start seeing is the coordinated reopening. There's a bit of a drama-filled moment right here at the beginning of 2022. This is the February bar. And of course, this is the Russian invasion of Ukraine. That's the swing high. You can see here. So we poke in the direction of $130 a barrel. And then we come right back down. We get about 2 months of thinking about this. And then we come back down. No amount of purported supply disruption, because a critical energy supplier, Russia, one of the top 3, basically comes off the everything is quiet, everything is business as usual list and moves into the potential for strong disruption list of nations. We then have, of course, the situation now on fire in the Middle East. That's right here. And not only does oil not even bother spiking, it's falling this entire time. And so now we're sitting in very close proximity to the floor that we've been carving out basically since the COVID run up, somewhere in the 65 area. So between 60 and 70 bucks a barrel, right here. And so this is why I say that something seems to be almost wrong with the market, because if you believe the headlines about OPEC plus cutting production, about disruption in the Persian Gulf, a key conduit for crude, of course, if you look at the headlines coming out of Russia and Ukraine, this seems like a market where the supply side of the story has been dramatically disrupted. Except the price action cares not at all, it would seem. So what is going on here? Why doesn't the oil market care? And why are these headlines ultimately nothing to be concerned about? At least according to the price action. Or is it the price action that's wrong? And all of these things have yet to make their impact really felt. Well, let's have a look at what this market looks like and what's going on. So this is from the Observatory of Economic Complexity. It's a great little graphic here, hat tip to them. We see here the breakdown of the market on the export and the import side. And we'll take each side together. And we'll start with the exporters and see what's actually happening with this disruption and why is it that the market thinks it doesn't matter. Obviously, we can see here that the big players taken together are Europe and the Middle East. When we look at the part of the chart right here, we can very clearly see that this is smaller than this. The red area and the purple area together are a bigger block than are the blue, yellow, and green put together. So we can clearly see it's the Middle East and it's Russia plus a bit of Norway and a bit of the UK that really matter as far as exporters of crude oil. And of course, this is also where the disruptions are. And then when we look at what's going on in Africa, in Latin America, in North America, what we find is something that's a smaller story and where, of course, those disruptions aren't. Let's deal with that step by step. So first, the Middle East. Here, the main story has been OPEC. OPEC has been talking up its production cuts. They've been saying we need to reduce output. They've been saying on the part of the Saudis, we will even do this unilaterally. But of course, what we found is probably the most overt display of disunity so far at the last OPEC meeting. So they expect that they expanded OPEC Plus, which is the OPEC cartel and like-minded producers outside of the cartel, like Russia. They expanded it to include Brazil, notably. Also, Angola came out and said, yeah, we hear you about the production cuts. We're just not going to do them. We really don't care what you think. We're in the group, but we're not going to participate, which was a very pointed display of we don't want to do it and you can't make us. But that wasn't a departure. It was just made more public than before. But as we can see here, while OPEC has been successful, kind of, at keeping output below production capacity, so in the yellow there is the production capacity in terms of barrels per day. You can see it's hovering, give or take, around 36 million barrels. we can see that their output has outstripped the quota basically for the entire duration that they've had a quota going back to 2014. At no point yet since this thing was introduced have they had any consistent period in which they've actually managed to get to the quota or to produce under it. And that's because there's constant cheating. There is a constant sense that OPEC can set these things. Financial journalists can write about them. They can meet in Vienna over surely excellent meals and talk about it. But when it comes time to actually claw back output to the quota, people don't want to do it. And so while some members might actually go do what they're supposed to do, others very quickly step into the breach and make up lost output. In fact, what we find is that it is the price leading the output rather than the other way around. Consider some of the recent moves. So here I've marked them A1 and A2 for this inflection point, then another inflection point here, the B's, the C's, the D's. And what you find here, notice, the peak in the price of crude here comes before the peak in output. So it's not like we see this working in a way where OPEC is shaping what's happening with the price. It seems to be the other way around. The price is shaping what OPEC does. Here we have the peak. Here we have the response. It's most telling at the bottom. Here we have the same thing. First the price bottoms, then output does. Here at the top again, the price tops, then output tops. And the takeaway here is that OPEC and its members are simply not in the business of selling cheap oil and not selling expensive oil. So when the price goes down, output is reduced because selling cheap oil is not as money-making of an enterprise. When the price bottoms and goes up, output goes up. In other words, OPEC actions on output seem not counter-cyclical to the price, but seem to follow it. And so, at the very least, this part of the story, the constant fretting over, will they cut output, won't they, what will Saudi say, what will other members of OPEC Plus say, we can probably safely write this off as a non-issue. It does not seem that they have the capacity to have much of an impact. They can't police the ranks to actually get to quota. There's constant cheating. And now we see the cheating overtly with Angola's pronouncement, basically not even trying to sugarcoat it. And Brazil, though it's joined, saying, yeah, we joined the group, so we'll come to the meeting, we'll eat the food, we'll drink the drinks, but we're not going to be bound by any output quota. So you can bring us in, we'll come hang out, but you're not telling us how much to produce. So we see this is probably not anything that the price should be worried about, and very plainly isn't. Let's look at the next aspect of this equation. So we don't have to worry about supply disruptions from OPEC cuts. The other main question, of course, here in the same region and also in Europe is geopolitics. Are we perhaps then concerned that wars, terrorism, and piracy are going to somehow disrupt this? Shouldn't the markets be worried about that? And for that, I think the most instructive thing is to take a look at how much is it actually costing to ship through this key area. Now, of course, in the case of Russia, this would be a sort of secondary indicator because, of course, Russia mainly is both allowed carve-outs in the sanctions, so there's less of a disruption here as a matter of course for energy, for grain, for fertilizer. But also a lot of what Russia does isn't seaborne through the usual routes. So a lot of it is pipeline. So let's consider what kind of a thing Russia would mean for shipping, but also, of course, to focus on the current story, what kind of a thing these attacks by Houthi rebels supported by Iran on shipping, and now the U.S.-led coalition of nations going into the Red Sea to keep that lane secure, what all of this means in context. So here is the relevant route. And this is, of course, going to capture both of these stories. The Suez Max tanker is the largest tanker that can pass through the Suez Canal fully loaded. If you were going to do a VLCC or a ULCC, a VLCC would be a very large crude carrier. A ULCC would be an ultra-large crude carrier. They can't get through the Suez Canal. You'd have to park them before, offload, bring the tanker through, reload it. So it's not really the world's greatest indicator. The Suez Max is the largest that can be fully loaded and just sail through the Suez, which is, of course, exactly the route for crude to get from the Gulf and into Europe. And of course, this is really the key area because we can see here, again, who the big buyers are. We can see the U.S. is a big exporter. It's a relatively modest importer because the U.S. is, in large part, self-sufficient. We can see Canada exports much more prodigiously than it imports. Again, because it's mostly self-sufficient. The really big areas are East Asia and Europe. And this is where the connection to Russia comes. So you look at what's going on here, and of course you see a giant spike in shipping costs around COVID. That's right here. This is because of lockdowns. This is because of ruptured supply chains. So, of course, it becomes much more expensive. This is a real disruption. This is a notable and unmistakable spike. Now look at what happens to the cost of shipping crude along the Red Sea from the Persian Gulf into the Mediterranean for European consumption. Here's Russia's invasion of Ukraine. Now, if there were a meaningful disruption as a consequence of this, you'd expect a spike because you would expect for it to become more expensive because of greater demand to ship through this alternative route because you'd think there would be more demand then for Gulf output. If Russia is disrupted and everybody else still needs oil, well, then there should be more demand for oil not from Russia. And so it should become increasingly more expensive because of that rabid demand to ship that oil, because there should be more demand for these tankers. Notice we're going up on the way out of COVID as demand builds back. And the Russian invasion is a blip. There's not even an outsized spike here. And so the market very plainly says, meh, this is not a big deal. There is much more of a spike when Hamas attacks Israel on October 7th. Notice, however, it doesn't challenge the recent highs from late last year, and it fizzles quickly. So the markets are looking at this and saying, yeah, maybe there's a pickup in the cost for container shipping through this area. And we've seen, if we looked at the Freightos index of container shipping costs, it's had a bit of a rise since early October. Modest, nothing like COVID. The trend is still down. But when it comes to crude, there's barely a blip. It's a little bit more than when Russia invades Ukraine, but not much going on here. So it would seem the geopolitical disruption is, aside from what's going on with OPEC Plus, another mostly irrelevant factor. So what is the driver of crude shipping costs? Well, shock of shocks, it's actual demand for crude. What we have here is global trade volume in everything. Collective global exports and imports added together to give you a sense of how much money is crossing borders as an aggregate volume. Notice it's been rebuilding since COVID. It tellingly crests just as the central banks begin their rate hike cycle, led by the Fed, and demand begins to wane. If we take this same cost of Suezmax Arabian Gulf to the Mediterranean tanker rate, and we lag it 7 months, because of course demand has to decline first, then the prices respond. What we find is that this is essentially just tracking global economic activity. When there is more demand for oil, because the global economy is accelerating, the cost to ship that oil goes up. When the demand wanes, the opposite, with about a 7-month lag. What does this say about crude oil? That all these outside factors might be good for clicks on financial news websites, but they're not what shape outcomes in the crude oil market. Here we have crude oil and an index of commodity prices from Bloomberg that pointedly excludes energy, so that we have no knock-on effect, not from natural gas, which incidentally is sinking, not from coal, not from any of it. We're looking at just non-energy commodities and crude. Notice they move in tandem. And just as we started to see commodities in general coming off, so too we have crude oil coming off, telling us this is not about energy being disrupted. This is not about OPEC forcing outcomes. This is about diminished demand for raw materials of every stripe. And it's because the global economy is slowing. as we just saw by the pullback in global volume of trade. It gets even more specific. If we look at the way crude has behaved relative to U.S. inventories, excluding the strategic petroleum reserve, there's a very clear supply and demand relationship here. When inventory goes up, so there's more supply relative to demand, the price goes down. When inventories go down, so there is more demand relative to supply, the price goes up. Rocket science, this is not. There is very little influence here, seemingly, from extemporaneous factors. This is more like the front page of an Economics 1 textbook. Supply, demand. So, with that in mind, then, what's next? What's going to happen with demand? Well, consider, as we like to point out here on Macro Money, that the global economy is 50% just three economies: the US, China, and the Eurozone. Taken together, they account for 50% of global GDP. Their influence is actually much greater than that because the other 50%, everybody else, they're largely vendors to the former three. So think Canada, Mexico for the US. Think all of Central Europe, Nordic Europe, and even the UK for the Eurozone. Think all of Oceania, most of Southeast Asia, large swaths of South America, certainly the commodity producers, large swaths of Africa, certainly the commodity producers, for China. You don't get demand in these three, and the other 50% is in trouble. So the influence from the three is even greater than the 50% that they have themselves. What's more, China is a middle step in the global supply chain, dependent itself on the Eurozone and the US for end demand. So really, the entire story here is mostly about what happens to rich world buyers in Western Europe, in the Eurozone, and in the United States. And the story there is hardly encouraging. Looking at the latest PMI numbers here, these are as of November. We don't have the final ones yet for December. But what we find here is that the U.S. is at standstill. In the logic of PMIs, as ever, 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And the U.S. here is at 50.7, a hair above standstill. China here, 50.4, a hair above standstill. Eurozone at 47.1, shrinking. And so what we find is that if crude oil is going to be powered by the global business cycle rather than these headline-grabbing would-be disruptions, the story does not look good because the key drivers of demand are misfiring. If we look at the way forward, we can see from a survey of economists by Bloomberg that GDP growth expectations for both next year and the year after have been consistently revised down all year, mainly as rate hikes have taken their toll and growth has slowed. This right here on the PMI side of things, there's the slowdown. And through the course of all of it, people have updated their expectations to see just how much vigor we are going to get next year and 2025. Now, of course, people get forecasts wrong. So we don't want to get overly committed there. But what's key is, even as these things are being revised down, data from Citigroup is showing us that actual economic outcomes globally, in developed markets and in emerging markets, have started to increasingly undershoot and weaken relative to forecasts. So the forecasts are going down, and the economy is so weak that even that is being undershot by realized outcomes, which really means that the situation is considerably weaker than even the revised down forecasts would imply. Not a friendly environment for crude oil if it is, in fact, the business cycle and nothing else of substance that actually matters. And so when we look at where we are for crude oil once again, and we're hovering at this range bottom here, right around the 65 mark, right in between somewhere the 60 to $70 a barrel area, what we find is that the path of least resistance might well point lower. And if we were to get a confirmed decline through that support area and end up, let's say, somewhere at 55 and find some follow through there, that the story for 2024 may well be of significant crude oil weakness. As ever, an asset that is not able to rally on news that seems like it should be positive has significant underlying weakness. And that appears to be exactly what the story in crude oil is telling us. That we're holding here on borrowed time. And that if we were to get through the floor right here and end up, let's say, somewhere over here, the path forward may well lead down this way rather than the other way around. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what it means going forward. Back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony Sundays for First Call, opining on the news and insights section of tastylive.com, and commenting sporadically on the platform formerly known as Twitter, @Ilya Spivak. Thanks very much for joining. Happy trading. See you soon.